Welcome back. Good Friday morning, everybody. Thanks so much for joining us this morning. I'm Maria Bartiromo, and I hope you're having a great Friday morning. It is Friday, May 1st, a new month, and it is just before 7 a.m. on the button on the East Coast. Chevron beating first quarter expectations as surging oil and natural gas prices boost results for the quarter. The company reporting adjusted profit hitting $2.8 billion above expectations, helped by contributions from Hess assets after the acquisition and strong refining margins. Production up year over year, double-digit growth seen in the Permian Basin and gains in the Gulf of America, all helping to offset outages related to the Iranian conflict. Net income coming in at $2.2 billion. That is down from a year ago of $3.5 billion a year ago, reflecting cost pressures and market volatility. Chevron also taking a hit in refining international operations, losing about $1 billion on weaker margins and higher transportation costs. Joining me now is the chairman and CEO of Chevron, Mike Wirth, joining us right now. Mike, thanks so much for being here this morning.
You're welcome, Maria. Good to see you.
And I'd like for you to characterize the quarter for us. Of course, oil prices have been surging in the middle of this Iran conflict, and yet earnings are down from a year ago. Can you assess the quarter and tell us what drove business and separate fundamentals from perhaps hedging dislocations or distortions?
Well, I think you did a great job of characterizing the quarter with strong U.S. production, record U.S. refinery runs in the month of March. And we've got a portfolio that's global and diversified with less exposure to the impacts in the Strait of Hormuz than some of the others in our industry. So it's a third consecutive quarter of U.S. production greater than 2 million barrels a day, integration of Hess, growth in the Permian, growth in the Gulf of America, record U.S. refinery throughput in the month of March, which has continued here into April and now May, and as I said, a diversified portfolio. So those are underlying fundamentals that are very strong. As you mentioned, there's some accounting effects relative to hedging of some of those flows that create a negative earnings impact in this quarter, which will likely reverse in subsequent quarters. So the underlying fundamentals remain very, very strong.
And that's thanks to your strong cash generation, helping you navigate this volatile geopolitical moment in time. Mike, when you were at the SARA conference, the energy conference, you said people are underestimating the impact of what has taken place here, and you warned that supply cannot respond quickly. Tell us about that, because, you know, Iran shot back at its Gulf partners, attacking allies, and that has impacted Chevron operations in the region. Can you give us a sense and assess the extent of that damage and how it's affecting infrastructure and your ability to get back up and running in those areas, like, for example, Qatar and other areas?
We've been relatively lesser impacted by the direct effects of the conflict than some others in the Gulf region. The real issue relative to the global market, Maria, is that the energy system remains under extreme stress. The world consumes about 100 million barrels of oil every day. Roughly 20% of that flows through the Strait of Hormuz, so it's the single largest artery for flows into the global market. 20% of global LNG flows through that same strait. And as that has been shut down, those supplies are not coming to the market. Now, there's some that can get out through the Red Sea, but not nearly as much as has been shut in. And so the world's short on supply. In the early days, weeks, and first couple of months here, the world's been able to pull on inventories that are held in various places, on land, in tanks, some excess inventories that were in ships on the water, and strategic inventories that are held by countries around the world for the case of an emergency. All of those are flowing into the market, but there's not enough to offset the supply that is being held back from the market by the conflict. And so in normal times, those surpluses work as a bit of a shock absorber, and they can buffer the effect of this outage on price. As that shock absorber becomes less effective because those inventories are lower and lower, what happens is we see more upward pressure on price, as there are very real concerns that we may move from a system that's supply constrained to one that's actually supply short, and where demand has to be curtailed in order to match the supply. And that's the concern going forward.
when I think about the Hormuz Strait situation and the security that is required there, how would you assess this blockade? And do you believe that it's okay and safe for these tankers to pass through? What is your assessment of the Strait right now?
Well, the Strait functionally remains closed still. There are very few ships that actually are transiting through the Strait. Normally, there's 130 or 140 ships a day that move through that. Today, it's in single digits, and often related to Iran and their efforts to move through the Strait. But then, of course, the blockade that the U.S. has imposed outside of the Strait is interdicting some of those flows. And so we've got a situation where there's a bit of a stalemate, and the movements through the region are essentially stopped. I think the security risks remain high. There are certainly reports that the Strait has been mined. We've seen attacks on ships over the last 2 months from Iran, and the U.S. has actually engaged in similar efforts to stop ships that are associated with Iran from moving. And so it remains a very high-risk region, and one where you don't see ship owners willing to move their assets and their people through the Strait because of those risks.
Yeah, and the president likes to say that the U.S. has a great opportunity, this opportunity of energy capacity, the fact that the U.S. is producing more oil today, more oil and gas today than Saudi Arabia and Russia combined. He said that in his address to the nation, and we've got the numbers here. Do you see evidence of more demand going to the Gulf of America, more demand and interest in the United States' capacity as a result of the Strait being closed and the impact to other countries?
Absolutely. And the president's right. The U.S. is not only the biggest producer of oil and gas now, but it's also the biggest exporter of oil and gas. We're seeing dozens of large crude-carrying vessels show up at the Gulf of America to load and take supplies in large amounts to Asia. The U.S. is sending out liquefied natural gas at the maximum capacity that we possibly can. Excuse me, much of that to Europe. And so the U.S. is helping meet the moment, not only here at home, where supplies are ample and the concerns about shortages really do not exist, absent maybe California, and we are helping meet the demands of the world. And so I think the U.S. energy industry is standing tall during this moment of need.
So do you think the market is still underestimating the impact of the Hormuz Strait?
Well, the market's looking forward, and I think it's been difficult for people to really have confidence in when the Strait reopens and those flows resume. And so when there's optimism about that, you'll see the price come down as the market believes that those supplies will begin to be restored globally. And then as we get news that would suggest the Strait may not open as soon, what you see is price start to creep back up. And every day, those sentiments seem to shift. But the reality is what's happening every day is the inventories around the world are being drawn down. And so the physical supply in the world is becoming tighter as the conflict goes on. And the futures market is trying to anticipate how that's resolved. And, of course, these things are difficult to predict.
And Mike, of course, Chevron has been in Venezuela for 100 years. We've talked about your opportunity in Venezuela, and President Trump has mentioned it many times. Can you tell us about the opportunity there and how significant you see that production, oil from Venezuela, becoming for Chevron and the world?
Well, Chevron is an advantaged incumbent in Venezuela because we've been there through most of the last 100 years. We have seen production there increase by a couple 100,000 barrels a day over the last 3 years or so. We believe that the ventures we're involved in could grow by up to 50% through the end of 2028. We recently added more resource through a swap of some acreage in Venezuela to strengthen our position even further. We're running Venezuelan crude in our refineries. We're well suited to run it, bring it to the U.S. and convert it to products that the U.S. markets need. And we're encouraged by some of the changes that we see there. We think the policy of the new administration is a step in the right direction. There are probably some more changes that we expect to be made in order to encourage more investment. But I think Venezuela has turned a corner and is on a good trajectory to become an important supplier to the U.S. and beyond.
So what would be your timeline, given all of these opportunities, Mike, in terms of more output from Chevron?
Well, we've grown our production in Venezuela this year. And as I said, over the next couple of years, we would expect to grow production up to 50% further. And with some of the changes I referred to, if those are made by the government that create the economic incentives and the contract certainty to invest even more, there are scenarios under which we could go beyond that. And so I think it's one of the places in the world where we really do have optimism.
And of course, the Hess acquisition showed through in this quarter with the Guyana assets. That's another opportunity. Can you tell us how significant that is and where it fits in the overall picture?
And we're very pleased with the Hess acquisition in North Dakota. That's helping meet U.S. energy needs. Certainly in the Gulf of America, we've combined our positions and now have the largest position in the Gulf of America. And Guyana is the new oil field in the world over the last couple of decades that really has tremendous potential. We're seeing production there grow. We're bringing that production to the U.S. as well. It's helping us meet the moment. In fact, freeing up supplies that we can move to some of our refineries in Asia because we can now bring oil from Guyana into the system here. And so we're using that to help meet some of these acute needs around the world for energy today. Very encouraging.
Mike, we were together in the Permian Basin. You were kind enough to walk us through your operations in the Permian Basin on the oil driller that we were on. This was a real growth engine for Chevron for so long. Tell us where that is moving. Is that moving to a cash harvesting phase as you moderate spending in the Permian Basin to what, $3.5 billion a year?
Correct. That is our capital spending there, down from over $5 billion a year. And look, this is a tremendous asset for the United States of America and certainly for our company. We're producing over 1 million barrels of oil and gas there every single day. Last quarter, about 1,050,000 barrels. It's been growing steadily over the last several years, and we are now using the proceeds from that production to help invest in production growth in other parts of the world. We're working on technology to improve recovery. We only recover about 10% of the molecules in the ground right now with today's techniques, and so we expect that to get better over time, and this is going to be a part of American energy security and American energy dominance for decades to come.
Mike, let me get your take on the news this week that the United Arab Emirates is leaving OPEC. I mean, President Trump obviously met with you and other oil executives at the White House this week. And I want to get your take on what went on in the meeting. But no doubt, one of the issues is this fact that UAE leaves OPEC. What is the impact? This was I mean, the UAE was a key member or is a key member of one of the group's biggest producers. How do you think this impacts overall production and the U.S.'s position?
Well, I think it's early to draw firm conclusions about the implications of this move. The UAE is a large and important member of OPEC today. The decisions about these things are made by sovereign nations with their own priorities and national interests in mind. And I think it's premature at this point to really conclude what it means for OPEC or for OPEC Plus. Certainly, those producers are responding to the same market dynamics that the rest of the industry is navigating today, and it's compounded in the case of the UAE and other OPEC members that are in the Gulf region as they deal with the security issues that come with the conflict. I think we need to stay tuned and see how this plays out over time. With respect to the meeting in the White House, it was a good discussion with several members of the administration who are keenly attuned to the market dynamics that are underway, that are asking good questions. This is an administration that engages with the business community frequently and really listens to input as they sort through some of the policy decisions that they're making and how they're managing the circumstances in the Middle East. And so it was a robust discussion. I can't really comment on the specifics, but I'm very pleased that this administration is engaged with the business community on a very regular basis.
You know, Mike, there's so many legs to this geopolitical volatility right now. I mean, for example, when you look at the Strait of Hormuz and what has taken place and Iran, you know, unable to generate hundreds of millions of dollars in oil sales because of the U.S. blockade and all of that stockpiling. What is your sense of all of that oil in stockpiles that Iran has to, you know, put in barrels right now because it can't sell it? And then I wanted to get your take on China and whether or not China will, as a result of all of this, have to change its production plans and pay for oil at market prices and perhaps rely less on Iran. What are your thoughts on the stockpiling and also the impact on China that this issue has been?
Well, as Iran can no longer export crude oil the way they had been, they're facing the same challenge that other producers inside the Strait are facing, which is you need to use the storage capacity that you have to flow your production that would otherwise go into the market into storage. And of course, there's a finite amount of storage that can be filled up. And so typically countries will use tanks on land. They'll use ships that are empty, that are at sea that they can fill up, but those ships can't go anywhere. And so over time, that capacity will be filled by Iranian production the way it is now by other Gulf producers who have been unable to move their production out into the global market. And at some point, that can require you to slow down production from your fields. And I think that dynamic now is going to be affecting every producer inside the Strait. China has an interesting situation. They've built very large strategic reserves over the last few years. In fact, by most accounts, the strategic oil reserves they hold are larger than the rest of the world combined. So their economy is protected by that. In the U.S., we drew our reserves down a few years ago and really haven't rebuilt them in any meaningful way. And so our reserve capacity is less, and China's in a position where they actually can protect their economy. And if they were to release those reserves, could help reduce some of the strain on the global energy system. I can't speak for what they will do, but they certainly have the reserve capacity to contribute to the solution here.
Yeah, thank you for that, Mike. Final question here as we wrap up. Mike, before this conflict, we would have been talking about an enormous need for energy and an enormous demand situation as a result of AI. We talked about that together in the Permian, but things have changed. Can you characterize the macro story for us from a demand position? How do things feel to you in terms of the economy right now post this Iran conflict, Mike?
The economy seems to be, in the U.S., still in very good shape. We're beginning to see the effects of this show up in Asia and to a certain degree in Europe. But in the U.S., we do see higher gasoline prices on the street. But the U.S. economy, if you look at all the other indicators, looks like it's still very, very healthy relative to the rest of the world. When you get to the AI situation, not much has changed. The demand for power in this country continues to be very strong. We are working on helping to meet that growing demand. We're uniquely positioned with an opportunity that we're developing in West Texas. We're in exclusive negotiations with Microsoft for large-scale power generation. It extends the U.S. natural gas value chain into power and then power into intelligence. And we produce a lot of gas here in the U.S. that can help support that as we're in this AI race with others around the world. And our company operates over 5 gigawatts of reliable power today. We can move quickly to market. We've got turbines that are arriving this year, a site secured, permitting underway. And so even as the global situation carries this volatility and uncertainty, we remain very focused on helping to support the U.S. and our customers here in the race to build data centers to power AI for the future.
All right, we will leave it there. Mike, it's great to have you this morning. We so appreciate your time. Thank you.
You bet, Maria. Good to see you.
All right, Mike Wirth joining us, Chairman and CEO at Chevron. We'll be right back. You're watching Mornings with Maria, live on Fox Business.